Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
Hit it. It's January 31st, 2020, episode 65. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome Mike Alkin, where we talk about his experience as a short seller, his move to being a long short manager, and finally his transformation into a deep value uranium investor. Then we're going to talk charts with Patrick, followed by a very special Kuppy's Corner.
Then in This Week in Trading History, we're going to talk Coca-Cola. We're going to discuss the top 3 things to watch next week.
But before we get started, let's get to our sponsors. And I'm very pleased to say that it's sponsors plural. Not only do we have our regular sponsor, but we have a new sponsor. And Lena, why don't you hop on and tell us about it?
Sure. Our new sponsor is Koyfin. Koyfin is a new platform that gives you professional-grade data and tools to analyze stocks and understand macro trends. It's a personal Bloomberg terminal for those who don't have $25,000 a year to spend on a Bloomberg. The best part, it's completely free. Go to Koyfin.com, that's Koyfin.com, and start using it today. And that's Koyfin.com, Koyfin.com.
Lena, you're going to get a new job. Going to be reading script or whatever it's called. I'm not sure. I know because you do hand modeling on the side as well. Okay, let's go.
Right.
It's our pleasure to have Rob and his group at Koyfin, and we're going to talk about that a little bit in the show later. But let's get to our beer sponsor. Who is our beer sponsor this week, Lena?
Our beer sponsor this week is Left Field Brewing Company's Go Ahead Raspberry Hibiscus Goes.
God.
So there's something
Lena,
about this beer here.
Oh, God.
When the Go Ahead
it's
run
sour.
is
I love
scored,
it. I love it. It's a sour beer.
When the go-ahead run is scored, it gives the team the lead position, dramatically propelling them forward in a close game situation. Bursting with plump, fresh raspberries, tart lemony hibiscus, and a gentle saltiness, our Ghost evokes the same dramatic celebratory moment in any game.
Okay, so when I opened
it's a baseball beer.
it was pink.
That's very
Just
telling.
like Ron Oberman or whatever his name from would tell us from Parks and Rec that is not beer. But it's actually, you know what
Patrick
I have to
likes
say?
it.
It's not as bad as I thought it was going to be. I don't know if it's the saltiness or something. It's out of all the sours, it is almost drinkable.
All right. Kev, give us a disclaimer, buddy.
Okay, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include Elon anxiety, gamma flip blight, and fake out fatigue. I got that last one. I got a bad case of that, Patrick.
Oh, there you go.
Okay, let's get Mike on the show. It's our pleasure to welcome Mike Alkin from Sachem Cove Partners. Mike, welcome to the show.
Thanks, Kevin. Appreciate the invite.
It's great to have you, but we were just laughing about it, that you actually had a podcast called, Talking Stocks and
Talking
Drinking
stocks
Beer. And
over beer.
That's right. You actually beat us to it. One of the things is that we were looking at it. You were doing this before. How did that come about? Like, how did you go about doing that?
I just thought it would be fun to do, and I started it, and it was one of these things where because I was talking a lot about uranium, I was speaking at some different conferences, and I thought, well, let's give this a shot, and because I originally realized that it's such an opaque, complicated industry that it would probably be interesting for people to get a look behind the curtain of how the industry works. And then it just kind of took off from there. And I did 80 episodes over, almost 2 years of something like that. And then it just became a little bit too much time-wise. And but it was a lot of fun when I did it.
Right, I can hear you now. The one question I have for you is, you say talking stocks over a beer. How many times did you limit it to a beer?
Multiple beers.
Okay.
Depending on the guest.
That's right. So let's talk a little bit about your background and how you got onto Wall Street and in the investment industry and your career. Where, what university did you go to, and how did you stumble upon the finance world?
Yeah, so I started out at the University of Arizona, and I did not complete there. I wound up coming back to New York, and I went to a school called Dowling College, and I have an undergrad degree in accounting. And
Right.
I was a broker at Smith Barney, and then that kind of and then that
With
kind
Bud
of
Fox.
yeah, way back in the early '90s, and then I wanted to get into financial journalism, and so I went to a school called Iona College and started a master's in journalism, and then I was working at I didn't finish the master's. I was halfway through, and I got a job at Financial World magazine, which it doesn't exist anymore, but way back when it was a very big national publication, and it had been around forever, and for decades and decades. But the publishing industry was changing, and but when I was there, I had an accounting degree, and a lot of the journalists would be working on really interesting stories, and I would help them. If balance sheet type stuff, if somebody was looking at an article where maybe it had a short bias slant to it, I would chip in, and I wound up. One of the editors there said to me one day, "You should work at a hedge fund." I said, "Well, I'm open to it," and I was intrigued by the hedge fund business, but I didn't have a typical Wall Street pedigree. I didn't have an MBA. I didn't go through the traditional channels, and one thing led to another. I got an introduction to somebody, to a hedge fund manager. I had breakfast with him, and he gave me a couple of companies to look at, to go do some research on, and I researched both of them. I gave him my opinion on them. I said they were both shorts, and they were, and they both crashed and burned. And he called me up shortly thereafter and said, "When can you start?" And that's how I got my start at a small hedge fund where I was a dedicated short seller, and it was a great way to cut my teeth in Wall Street, really looking at things from the short side, and it's where you really realize that so much of investing is art versus science, and how to do fundamental primary research in the field, away from Wall Street, away from the noise. Reading the balance sheets and cash flow statements and income statements, they say one thing, but then it's about matter of going out into the field and talking to myriad people, whether it's customers, suppliers, former employees, and then putting that mosaic of information together to confirm or refute what you think the numbers are telling you in the financial statements. And that's how I got my start.
When you were at that short hedge fund, did you guys run a concentrated book? Like, was it one of these firms that's like 10 names that they're short?
Great question. So there were two funds within the one fund. There was a long short fund, and then there was a short only fund. And it was fairly, back then, it's very interesting. Back then, in the mid-ish part of the 90s, what you had was a very different hedge fund industry than exists today. Today there's, I don't know, 8,000-9,000 hedge funds. And the reporting requirements to investors, constant communication, monthly reporting, and so on and so forth. Back then, it was very different. There were maybe less than 1,000. I think there were like 500-700 hedge funds, and you might write a quarterly report. Maybe every half year you would write a report, and there wasn't the huge institutional money that was in the space. A lot of high net worth people, and some institutional money was coming into the space. But what that allowed you to do was, when you're looking, it's an absolute return vehicle. So your goal is to be up, whether the market's up or down. And a lot of what you're looking for are ideas that are not consensus. And when something isn't consensus, it's either out of favor or it's on the long side, or too much in favor on the short side. And you don't get inflection points right away, but you're seeing something that leads you down the path to look to see if there's some sort of asymmetry in the risk reward that people may not be looking at. Well, that takes time. And so back then, it was much easier to do because you didn't have to constantly report your numbers every month, right? It was you could have a bad month, you could have 2 bad months, and it's a very different ball game right now. So as far as portfolio concentration, yeah, we were fairly concentrated. There are so few good ideas in any given year that when you find a good one, or 2 or 3 or 5, you make your bets. So it was a great experience to understand not just how to do fundamental research, but all that started my knowledge base of portfolio management.
Right. One of the things that I've often found with short sellers is they tout the wisdom you should never short valuation alone.
Absolutely.
Did you come to that same conclusion? And
Yeah.
how did you go about coming to that conclusion?
I did. I had the great fortune to work for a gentleman named Joe DiMenna, one of the great hedge fund managers of our a generation, and he and Marty Zweig had a fund called Zweig DiMenna. And Marty Zweig, those who are older will know Marty Zweig was a high-profile economist, and
that's right. He was the one who got on Lou Rukeyser's show and called the crash on the Friday night, right?
Absolutely. And I had the pleasure of working for Marty and Joe, and it was a big hedge fund at the time, but it was still a small organization, and it was really, you learned from some really, really smart and talented people. And one of the things I learned from Joe is you don't short valuation. And I learned that very early in my career. And who are you to be the arbiter of what somebody else will pay for a stock, right? And so you need to, it certainly can come on your radar screen that there's some sort of a valuation disconnect. But to be the one to say, here's what this thing is worth, that's awfully arrogant, because you never know what somebody else is willing to pay for something. So we always, I learned early on that you have to have some sort of a catalyst, and it doesn't need to be the catalyst that the sell-side analysts or the market is identifying, whatever it may be. That may be their catalyst, but you need to have something, some strain in the numbers on the short side where you see something that you think you're nearing an inflection point. Now, that's the hard part about short selling, right? Because unlike a long, you know what your risk is. It goes to zero. But as a short, it could keep going up and up and up, and it's endless risk. And that's where you learn how to size into positions, right? That's where you learn how to, you're going to be typically early. The best ideas that you find, you're way early. You're seeing something. It might be the days sales outstanding, or the cash flow growth is not keeping up with the income growth. So something might be funky going on. So you're kind of like looking at all these numbers, and they kind of lead you in different directions. And then when one starts to add up to another and another, and they start piling up, now you know where to go out and into the field and do your work. Is it inventory? Is it receivables? What's going on there? Who do I need to talk to? And then it's a matter of saying, okay, this is what I see. I think that there's good reason that they're going to miss the estimates, let's say. But now it's a matter of figuring out when that is, and then sizing into the position. And the thing you learn is to start small. You can't be a hero, and it's okay. You're going to be early, and the stock's going to go against you, but you want to have someone. There's the old thing as a PM. If it's not on the sheets, you forget about it. So you put a little bit on the sheets meaning in the portfolio, and then you start doing the work, and then it just kind of takes a life of its own. Depending on how many names you have in your portfolio as an analyst or a PM, you tend to, as you do more and more work and uncover more and more, it takes more of your time, and then you start to either develop or not develop conviction in it, and then you start to size accordingly. And a lot of it is understanding, with bigger names, mid-sized, larger cap names, is what are Wall Street's expectations? Because, right, it's an expectations game. Are they going to meet, beat, or miss the numbers? And it's hard to get that right on every quarter because companies can pull magic out of a hat. So you have to try and prepare for what can this company do? What levers can they pull to make these numbers? Especially if it's a company that's very consistently playing the beat and raise game. They beat and they raise estimates. What is it that they can do? And then as you start to narrow down and they become more boxed into a corner, you start to think about, maybe I need to start getting bigger here. If you're getting field confirmation and you're seeing it in the numbers. So it's really, there's a lot of art that goes to that. And it's still really hard.
Right, so that,
you're going to take it on the chin.
Yeah, no, it's a tough game. And that idea of going small at first because expecting it to go against you is so kind of wise. And I'm thinking to myself, how many times have I gone and looked at a short name and gone too big, too fast, and found that the valuation just keeps rallying in my face. So when you were talking about that hedge fund, was that the original hedge fund, or is that your second hedge fund?
That was my second fund, right? My first one was a smaller one. It managed maybe $150 million. The first one, and then the second one was a $10 billion fund.
Right. And so did you stay, how long did you stay there, and what did you eventually become a long short manager?
I did. I was there a few years, and then I moved on. It was a tremendous education. And, those were 80, 90, 100-hour weeks, and which I loved, and I learned so much out of it. And then I had an opportunity to to grow in my career, where I was able to take on more of not just a short selling role, but I was able to morph into, now it was like the next stage for me, and it was to be able to do, I was introduced through a very good friend who's now become a very good friend of mine, a guy running a fund, and I was able to become more of like special situations on the long side, looking for deep out of favor industries, and they were a value manager, and then I was able to also do short selling because for having whatever that was, 5 years of short selling experience really was a lot, and having learned at the feet of some really smart people, I was able to bring that expertise on the short side. And I say expertise, you're never expert at anything, but you have the experience, and you learn from your mistakes. And so it was there that I was able to do that as a long short. I started to develop really my skills as a long, deep value manager, analyst. And then from there, after a few years, I was offered a partnership at a $4.5 billion hedge fund, where I was able to. I went in as a partner, stayed there for several years, where it was a much more full blown portfolio, bigger position, and I was able to really. It was wonderful because my boss, the general partner of the fund, had the fund for. By that time, he had it for probably 25 years, had a terrific track record, and really that's where I learned the art of patient value investing, where you are able to have an opinion that's quite contrary to what the market is pricing in the stock at the given time. But again, from doing that field work, the fundamental analysis, and then really saying, what do I now? Here's the flip side of that. On the long side, what is the market pricing in right now? And you typically find this in cyclical businesses where there's peaks and troughs. And around troughs and around peaks, people price in recency bias. They price in what has happened recently into their forward forecasts. And the blinders go on as to normal cycle. What could happen when things turn, when supply is restricted and demand starts to accelerate a little bit? What do those numbers look like? And again, that takes time for those to work out and to work through, oversupply to come out. But I was very fortunate to work for somebody who'd been through many, many cycles and didn't turn on his Bloomberg screen some days and didn't care what the market analyst said, what the sell-side analyst said. It was about, what does our own analysis say? Expectations may be fine, that's okay, but the price is so washed out right here that there's very little downside and significant upside. And that's really where I started to hone in on, and as an analyst, by the way, Kevin, when you start out, you don't know anything. You're happy to have a job. Okay, I'm a short seller. Great. It happened to fit my personality. Those who know me, my close friends, my family and friends would say I'm a pretty go along, get along guy. But in the way I look at the world, I'm skeptical. I'm very skeptical. I'm very contrarian. And so that fits as a guy who's a short seller. It also fits for a guy who's a deep value long investor. So And you have to, when you're first starting, you're happy to have a job and you're working, and then you start to see different things as to different styles. You meet different managers. Some guys are growth guys. Some guys are fantastic. They could see the big picture, and they could own a stock. Somebody could have bought Amazon at 10. I wasn't that guy. I know my strengths and weaknesses. I'm a grinder, and I know that I'm contrarian. And I know that I'm looking for things that people don't like or they like too much, right? So it just naturally fit my personality. And as you morph in your career, you then start to take those opportunities that fit that, and you start to develop your own investment style. But you're always learning, and I still learn today. But the great thing I learned over that many years was to mentally disconnect from the noise of the market, and you have to have conviction to do that, and sometimes you're wrong. You have to be intellectually honest. If you have a thesis and that thesis is playing out as planned, but the prices aren't responding to what your work is uncovering, you have to ask yourself two things. One, am I focused on the right things within my thesis? Is my thesis working out? Yes. Okay. But is my thesis based upon the things that will make it ultimately work? And you're constantly challenging yourself that. And if those answers are yes, you just step back, and you let the market do what it's going to do. And again, you're sizing your position, you're managing it, you're not going full boat right away. But that was where I was very fortunate to really be able to just shut the screens off, because watching prices doesn't help you become a better investor. It helps you become a reactionary investor. And it defeats the purpose if you're looking for things that are either out of favor or way too in favor if you're looking to short something. So for me, that's where I really kind of, you start to hone your skills when you start to recognize who you are as an investor, what your strengths and weaknesses are, and then really importantly, what industries do you think that you kind of could understand, and what's natural and what's not. For me, financial institutions, banks, the balance sheets of banks, they didn't make sense. I mean, I understand them from a fundamental standpoint, but they're so opaque in the sense that there's so many different levers within a bank that you just never can see what's going on. That for me, it wasn't something I was comfortable with, so I didn't do them. Biotechnology, it didn't make sense to me, right? So you learn what industries you can learn and what industries that just don't inherently make sense to you. And so if you fast forward, and here I am.
Our interview with Mike ran long, and we didn't want to stop the great conversation, so we had to cut the interview into two parts. The first you've just heard, the second half can be found after our regular segments. Make sure you tune in to get Mike's deep dive on the uranium market and the opportunities for value investors in the space. Now we go on to my favorite part, talking charts. And one of the reasons that I like doing this, Patrick, is that I just sit back and listen to you talk charts.
Well, and particularly, before we do, I'm going to actually be using the Koyfin platform, which is our sponsor. And so, the Koyfin is such an amazing product in terms of just the fact that you can not get all the accessibility like you would on a Bloomberg machine, but you get it for free. You don't have to pay $2,000 a month for getting one of these terminals. So,
what, Patrick, I'm going to interrupt you here. One of the things that I actually find the kind of very endearing about the product is that Rob actually used many of the same actual commands.
Yeah.
So that if you are an ex-Bloomberg user that is no longer wants to shell out the $25,000, or I think it might be more, the Bloomberg tax, you can go and look at Bloomberg at Koyfin and get a lot of the terrific things. And some of the things that this thing will do is just outstanding. I highly recommend that everyone go. It's a free account. Go sign up, Koyfin, KOYFIN.com, and make sure you get an account. You're going to be shocked at what it can do for a free product. It's second to none.
All right, so let's get to some charts. So I want to talk about the first thing. First of all, let's just talk some fixed income, because one of the most interesting things Rob pointed out to me, which I wanted to, you've talked about it in the past as well, and I want to talk about the yield curve and the inversions. But when we look at the global yield curve matrix down here at the bottom right, where's all the red, Kev? It's Canada.
I know.
Like
Canada yield curve is the only inverted yield curve in the global markets. Actually, I shouldn't say that because the U.S. did go inverted on a
3-month to 10-year basis.
Exactly. And so, but the Canadian yield curve, so on the chart at the top, we have basically the 2s and 10s for Canada, Germany, and the United States. And you can see while we approached that inversion on 2 10s on the U.S., and temporarily did, Canada has been consistently inverted. It's pretty interesting to see that.
You know, a lot of people try to tell me that it doesn't matter. The Canadians, an idiosyncratic market, that and the yield curve doesn't mean anything. I call bullshit on that. I think it means something just like in any other market, and I think it says weaknesses ahead for the Canadian economy.
Right. So what I want to do is I want to pull up this chart of the S&P 500 right over here. And what's amazing here is we had a pretty heavy dump in the markets today going into the Friday close.
I said pardon. Wasn't expecting that. You know, descriptive, Patrick. But anyways, let's go with it.
Anyway, but it's interesting because we did cross the gamma flip line, which is the high volatility zone. And what was interesting is we had just the other day after the Fed that after the WHO, the World Health Organization, came out, the market had this pop higher. And everyone's like, oh, that must be all over. But I was saying to my members, like, you know what? 30 to 40 point days is actually the new normal. When you have the volatility come back, that's just like the normal daily swings. And how quickly the market reversed back down. I think today's break solidifies that this is not one of these 1-2 day, 70 to 100 point corrections, but that a deeper, more meaningful, 5 to 10% market correction that's going to be a couple hundred S&P points is underway. I think we're heading probably even towards 3,000 on the S&P here.
Sounds like a bear we got in there. The only thing I'd like to say to this, Patrick, is that I wrote a piece that said something highlighting the fact that Bridgewater co-CIO Bob Prince said something about the boom-bust cycle being over. He did this at Davos while he was hobnobbing with all the private jet set lecturing us on climate change. But I'll take you back a couple of years ago. Ray Dalio did something very similar where he actually said cash is trash, and that ended up being the top. This Davos thing ends up being often the top in the market. I don't know if it's because they're all buying stocks into front of that, but here we are again in the same scenarios, playing out.
Yeah. I wanted to also, I'm going to use the iPath oil ETF to kind of get a chart here on oil, just to get an idea of where the levels are. But you can see crude oil was trading down to back down to that $50 to $52 range on the bottom end. And what a key support line. I mean, you're going to probably give me the triple bottoms thing all over again. But this is a major support. And it'll be really interesting to see whether or not oil rips through the zone. Because I remember that period in 2018 at the tail end when oil was nosediving through this market correction phase right over here. And I remember saying, oh my God, this thing is oversold. How much lower can this thing go? And every day it was down again, ripping through every support line just in a bloodbath sell-off. And so one of the things that I'm going to be watching here is that is this support going to offer the bounce, which technicians often will look for here. But if we see that this support comes down here and creates that bounce, so that's like an opportunity fade. But what if that gives out? Then how low does oil go? I don't know. That's
well, Patrick, if that support line holds, that will be not only a triple bottom, but a quadruple bottom. And if triple bottoms are rare, quadruple bottoms are like unicorns. So I'm thinking that it probably won't hold, even though I want it to hold because I think I actually own some oil. But anyways, and as far as how low it'll go, that's why I'm going to wait for your Fibonacci kind of forecasts and things like that.
All right. Well, listen, this is last chart I want to talk about is gold. The GLD we'll use as the proxy here. But again, the gold seems to be getting bid here, like a little bit of a safe haven in this environment, right?
Well, it is. I don't know, Patrick. Is that a cup on a handle saucer pattern or whatever it is?
Yeah, exactly. We call they're flags and wedges that are breaking, but you can call it
Well, I don't know. It does look like that. One of the things that I will talk about in terms of gold is that with bonds ripping and like just screaming higher. Real rates are really low, and that's one of the biggest factors on gold.
Yeah.
And it's no surprise that gold's headed higher. Patrick, one of the things that I've noticed recently is that the silver gold ratio has gold has been outperforming silver, and I've been watching for an opportunity to put that trade back on. So it's something that just put on your radar, because I think that at one point it's going to be great. Silver's acting well. I kind of like that trade.
Right. And so, it's definitely going to be one of the things that we're going to keep an eye on as to whether that widens there. Anyway.
Look at that. You can do it on the Koyfin. Unbelievable.
Yeah, absolutely.
There we go.
So there you go. There's your gold.
So one of the things that I've noticed is that, it rallied from the bottom and it's come back up. And I think that it's one of these opportunities that longer term that silver is going to outperform gold. It's dirt cheap, and there's been so many people flooding into the gold market, leaving our poor little silver behind. I'm a big silver bull.
All right. So let's go on.
Okay, it's that time of month again. It's when Harris comes and joins us, Kuppy's Corner. Harris, big welcome. Although I think that there's probably other days that you would rather be talking about something different, right?
Yeah. It's been something of a brutal January.
It's just been volatile. I can't believe it. Harris, I don't know how you've done, but I came in. I think at one point I was up the size and I went down size. It's just been all over the map. What do you make of it?
I don't know. I mean, I've had one of my worst months I think I've had in many, many years. And I don't get it, but it's part of the game, right?
Yeah. Well, let's jump into it and let's talk about some different things. Let's start with Stage Stores. It actually was one of your things that you recommended. There was it got halved. You got out. Thank God you got out, and you wrote about it and got everyone out. But what's going on there? What do you think? Is it done? Should we take it off the screen?
I think you take it off the screen. If you look at what I do, style-wise, I look for asymmetric opportunities where you risk something small to potentially make something large. Right. And you have to be disciplined that if your thesis isn't panning out, you get the hell out of the way. And Stage Stores, the thesis was it was converting from a dying department store chain to something better, off-price retail. And, they seem to be making a lot of progress in Q2 and Q3. The stock went up a lot. I sold a few, but clearly not enough. And then they announced holiday comps, and it was a disaster. And I met management that day in Orlando, and they couldn't really answer any questions. I don't know if they were being evasive. I don't know if they just literally didn't know the answers, but it wasn't confidence inspiring in any way. And I just told myself, the first update, I'm getting the hell out of this thing. And, I ended up selling mine in the high threes. My cost basis was kind of the low mid threes. I actually made some money on this, which is surprising because I got the thesis totally wrong. But, but that's the whole point of asymmetry. It's that you can be totally wrong and you still should be able to get out for, a small gain, small loss. And, I'm going to have a lot of chops. It's part of the business. When you're looking at asymmetric stuff, you have one or two winners that make up for all your chops and the occasional loser. And in this case, it's wrong.
It's like trading a long gamma strategy. You lose, and then you make, and that pays for all the other ones. So,
but you have to be disciplined. Disciplined. When you're wrong, you get the hell out of the way, especially when you have a bad balance sheet.
Well, then let's talk about one of the things that's not going your way as well is the shipbuilding, the ship tankers.
Yeah, what's going on with Sting, bud?
Oh God. So let's talk big picture on tankers, okay? Big picture is that you have IMO 2020, which is making older vessels obsolete. It's raising tanker prices, and you have a bunch of demand coming from Asia and India, and you have a bunch of supply coming from U.S. Gulf of Mexico, Brazil, Guyana, West Africa. Very, very big picture. The energy has to get to Asia, and you need tankers, and those are much longer routes than Arabian Gulf. And charter prices spiked, Q4. It was great. Q1 is phenomenal because these guys locked in charter prices at the peaks. Q1 will be the best quarter in 10 years for any tanker company. And then I think you had a lot of shipping tourists, I guess, investment tourists in these companies.
Look, that's a new one. Shipping like tourists. Patrick. I like it. Yeah.
I thought you'd like it, Kevin. But in the end, I think people are looking at this and they're looking and they're saying, VLCC. Let's just talk VLCC because it's the big vessel everyone looks at. It was 120,000. last week of December. Everyone got super excited, plugged into their model, and said, "Wow, these guys make a ton of money." Well, a VLCC today is 50,000. It's dropped off more than half in a month, and everyone's panicking. Oh my God, it's 50,000! The world's ending. And I think people forget that this time last year was like 30,000, so we're up 20,000 year over year. And that's with, Wuhan zombie flu, and that's with, all the other stuff that's happening right now. I mean, year over year, we're up quite dramatically. And I look at this from a year over year. You can't do it month to month because it's seasonal. And I think you had a lot of guys that got really crowded in some of these names, and they totally panicked. And I don't think there's a reason to be panicking right now.
All right, so Kuppy, what I wanted to ask you, to me, I felt with the IMO 2020 that this felt incredibly like what happened with cannabis when it was being legalized in Canada, which is it was the buy rumors, sell news. And so as we were going into this year end when this transition was going, everyone's sort of buying it up into that. And then just as everything turned, it became a sell. Like, is there any, what do you think of that idea?
Well, obviously that's what happened. And look, I took a few off near the highs, and I know this is seasonal. I had some call options, and I exited those really nicely. But in the end, I think people got in their head the wrong idea as to what was happening. I think people expected these rates to go to some crazy, crazy number, and that's just not the way shipping works. If rates had gone to a crazy number, no one would be chartering vessels. In the end, rates went to a very, very good number, and they're still at a very good number. And
Patrick, I'll push back on your cannabis analogy. The cannabis stocks weren't making any money. These companies are actually making money, and this is actually a much more fundamental basis. So it's actually a much better proposition. So the $64,000 question, Kuppy, is: are you buying more down here?
Yeah, I have been. I'm a sucker, but I've been buying. I mean, I took some off the highs, not enough clearly. I've been buying more down here. Look, Uranav reported yesterday, the first tanker company to report. You have a $10 stock. They reported $1.10 in earnings for, in cash flow for Q4. It's probably going to be almost $2 in Q1. So you have a $10 stock that has $3 booked for a 6-month period. I mean, let's assume they make no money the rest of the year. This company trades at 3 times earnings, and NAV is something like 13 or 14, and here we are at 10. Euronav has a policy to pay out 80% of earnings in dividends and buybacks. I mean, look, if they pay out a $3 dividend, it's not going to be a 30% dividend yield. It makes no sense. And I think a lot of people think the trade is over because IMO 2020, it happened and there was no fireworks. Like, IMO 2020 is keeping rates very elevated. I think people are just wrong here.
Right. And I'll be honest with you, Kuppy. I joined in the shipping tourist phenomenon here. I've been picking away as well because I think that this Wu-Tang zombie flu, as you talk about it, is greatly over kind of priced in, but at the very least that the market has gotten ahead of itself. And what I find interesting is what they've chosen to go after. They haven't gone and sold the regular stock market. They've gone and sold very specific parts of the stock market. And I think for some reason they chose shipping as one of those things. And I guess it's a fear that if nobody's buying anything and world trade collapses, it's going to affect it. What are the concerns about whether world trade, is a decline in world trade would cause the sensitivity of these shipping stocks to actually their earnings to collapse?
Well, yeah, look, if we're all dead, then no one's trading anything.
Right, but let's not assume that we're all dead. It's not Walking Dead. But let's talk about what if we end up not trading as much with China.
Well, look, I think you're going to see charter rates decline. Meanwhile, Trump, the great negotiator, negotiated with China that they're going to buy a lot of U.S. energy products. I think it's something of a force majeure right now because most Chinese are, sitting at home and eating ramen and playing video games as opposed to using energy. But, this will fix itself eventually. And I don't know, there'll be a couple month lag and then China's going to go use a lot of U.S. energy. If rates permanently are at a loss-making level, then yes, it's a problem. But if you look at these companies, I mean, look at this Euronav. They've retained $3 a share on a $10 share price in cash. Like, they're going to use that money to delever. They're going to use that money for something else. All these companies have retained somewhere between a quarter and half of their market caps in cash in the last 6 months. So they're dramatically de-risked from a share price perspective. I just don't see that much downside here. Of course, it'll trade wherever it trades in the short term, but longer term, look, China's going to keep growing and they need energy. And the energy is probably going to come more from North America.
Okay, so there's a lot of dislocations happening in the market. It seems to be that the only 5 stocks are going up, Microsoft, Google, Amazon, and Apple, and some Tesla. What is this creating opportunities? Are there other names that are getting cheap enough that you're looking to buy? Like, you're a true value investor. I saw the other day that the value versus growth had its largest one-day move against value in the past 20 years. Are there names that are hitting your radar?
Yeah, of course there are. There's tons of stuff I'm looking at. There's tons of really cheap stuff. I haven't really adjusted my portfolio that much. I'm kind of sitting and waiting, but there's a lot of cheap stuff out there. Just the question is, it's been a lot of cheap stuff for 5 years now. When does it bottom and stop getting cheaper? You could look at, say, coal stocks. I mean, I don't think they've had an update yet this year. These things trade at less than 1 times last year's cash flow. It makes no sense. Your shipping stocks are like 2 times last year's cash flow, or eventually this will adjust itself, and you got to be long, but it could go a lot lower first. You need some sort of catalyst. You need something to bottom this. Right now, all the money keeps going into ETFs, which are buying the same 5 stocks, and all the money's coming out of the other names.
Right, and then when you combine it with the ESG, like you're, recommending coal, which is the dirtiest of the fossil fuels, kind of like, you're going to have to go and repent your sins for just even suggesting that you belong, something like that, Harris. What about energy stocks like crude oil and nat gas stocks? Is there anything that's interesting you there?
I mean, look, they're all interesting. I don't think oil stays here at 51. I don't think nat gas stays here at $1.85. I think you got to buy it when they're all bleeding, not when they're all making money. I just don't know if you got to buy it today or you could buy it in 3 months or 6 months. I just don't really know. Every time I try to buy it, I lose money. So a little gun shy here.
Give us some names that you like, that over the next 3 months you're going to be looking and picking away at if it gets cheap enough.
All right. So I'm a perpetual bag holder in Sandridge. So let's just talk about that again. Look, at this point, there's a 91 million market cap, okay? Mind you, Carl Icahn, it's a $2.50 stock. He paid 17.
Is he still a shareholder?
He still is. They, for whatever reason, he told his guys to go drill holes. I'm not really sure why, but they did. And they basically put $1 in the ground. They'll probably get 60 to 70 cents out. It's value destructive, which is odd for Icahn. He likes making money. But in the end, you have this 91 million market cap company. I think they'll do 100 million in cash flow over the next 12 months. Even at today's commodity prices, maybe it's 75 million they do. They as I said, they've been putting a ton of money into the ground drilling holes, but they just fired the guy who's drilling the holes. If you read the press release and kind of read through the lines, it sort of sounds like they're going to fire the whole development team and stop drilling holes and basically put this thing into runoff. They're going to take in, like I said, let's call it 75 million at today's energy prices. They have 62 million of debt. They got to pay that off. And then they're probably going to do something accretive, like buy back stock or take it private. I don't really know what they're going to do, but the price is wrong. And meanwhile, you have all the upside leverage to energy prices if they ever do recover. Plus, they own their corporate headquarters, which is probably worth somewhere in the 50 to 100 million range. It just seems priced wrong at 92 million.
The corporate headquarters is probably the most attractive part of that asset.
Well, it covers the whole debt. So, you're basically buying 75 million of cash flow for 92.
Right. I get it. I'm just laughing because it's just nobody's going to want the energy asset. They're all going to want the real estate.
Yeah. No, who wants 600,000 square feet in Oklahoma either?
Well, Warren might. You never know.
But in any case, look, there's a lot of these that are really cheap. I have a shopping list. I haven't really plunged on anything yet. Just been kind of sitting around and waiting. I guess.
What about on the short side? At one point you had given up on the short side, saying that
I've given up.
Does it make? Oh, you're still giving up. And
No.
what about the SPACs? We talked about SPACs and the fact that a lot of them don't seem to work on the other side when they finally get converted into companies. Have you done any more kind of analysis there in terms of?
Yeah, the vast majority of them collapse, and they're probably a great place to go looking for shorts. These are companies that couldn't IPO. If you look at what happened with the Ponzi sector, okay, they've had a bunch of IPOs fail ever since WeWork. And so these guys can't get public, but the insiders want to cash out. So what they're doing is they're cashing out into SPACs. So you have these companies that are going public in like a 200-300 million SPAC, but there's like a multi-billion market cap value. And then as soon as the trade window is done, they just start dumping stock. I think it just sets up perfectly to make a fortune. But then, you have things like Virgin Galactic, which goes up every day anyway. So who knows?
That's right. You're missing out. You weren't a believer in the Tesla, and you're not a believer in space travel either.
But they're not even doing space travel. At least Tesla creates cars. These guys are they're not doing anything. It's just a stock promote. They have not put anyone in space yet.
You haven't embraced it. You haven't understood the true potential.
Yes, the Ponzi sector is so amazing. It's phenomenal.
It's actually a great stock in terms of the volatility and the madness of it. And I'll tell you one thing. I think some of the Teslonians have moved on to the space. It seems to be that it's the new. No, honestly, I've seen guys that have been like, "Oh, okay, that thing's already run. Now we're going to go run this one up." It
but
feels
some of these,
like
none of this makes sense. Like these guys are chasing these stories like this luck in coffee. Like I met these guys at ICR. Their big business plan was to have coffee dispensers where you put some coins in and out comes coffee. Like this is stuff from the 1960s in America, and I don't think it's even revolutionary in China. And they don't even make money doing it. I just don't understand how this stock went from like 20 to 50.
Well,
none
did
of
you
stuff
see
makes
the
sense.
news today that Muddy Waters did a short report on it? He's talking about it being an outright fraud.
I haven't read it yet. I wouldn't surprise me if it was outright fraud. We met with management. They couldn't answer basic questions like, what's your return on capital of this dispenser machine? it just, like, literally, their corporate presentation made no sense. Like, it just literally made no sense.
We'd hit that point in the market when all you needed was to kind of have a dream, and those people would be the ones that saw their stocks explode higher. And it's kind of crazy. Like you've railed against the Pelotons and all this stuff. Here's a question for you: do you think that this is the start of this froth coming out of the market?
I don't know. I mean, look, it's one down day. Meanwhile, Tesla's
more than
still
one
up.
down day. Yeah, well, Tesla is now quality, so people are running to quality on a down day. But it's more than one down day. We're a couple weeks into kind of potentially what could be the top. The ironic thing is, I just tweeted it out today, Harrison. It's something. Do you remember Ray Dalio's partner saying something about the boom bust cycle is over?
Yeah. Well, they changed their minds in 2 weeks.
He top ticked it literally to the hour. I went and looked it up because I remember I wrote a piece and then I looked it up. He ticked it to the hour. And the last time they were in Davos, Ray Dalio said something about cash is trash. He top ticked it almost to the hour then too. It's actually kind of amazing. And who would have thought? With because it was looking so great, but I guess it's the flu. This flu. What do you think? Do you think that I'm overreacting by dismissing, or sorry, not overreacting, underreacting by dismissing the potential fallout of the flu? Like your gut reaction. Where are we in terms of this flu a month from now?
I got a feeling it's escaped China, and we're all going to end up getting it. I don't really know how bad it is for you because being China, no one actually believes the mortality data. I really don't know. Look, I sent my wife to the grocery store. We have a 6-month supply of canned tuna. We bought some of those N95 masks. That's why Amazon's up $200 today. And look, I think we might just camp out here in South Beach in my condo, duct tape the door shut, and watch Netflix for the next 6 months. Like, I don't really know. Like, I could see this totally freezing global growth.
You're going to be sick of tuna in 6 months, I'll tell you that much.
I'd be sick after about 2 days. But you can also go the other direction and, you get a mild cold and life goes on. And somewhere between those goalposts is what's really going to happen. But yes, I really do think that it's kind of frozen in China right now, the economy. And, you have a lot of these companies that are priced for perfection and they're totally going to miss. They're going to miss badly their Q1 numbers. And I don't really know if it's priced in, or maybe the market is smart and it's looking past it and saying it doesn't really matter. So,
well, I think it's a that's what's going to increasingly happen. The other thing to think about, kind of second order effect, is if it's really that bad in China, the amount of stimulus that they're going to throw at it is going to be unprecedented.
Oh, unprecedented. I mean, that's why I'm so bullish long tankers. I mean, think of it today, okay? You're a shipping executive. You can't go to your board of directors and say, we need to order some new tankers, because you don't know what it looks like for another 3 or 4 months. So there's going to be a gap in ordering. So you're going to keep your order books thin. Your fleets are getting older. Your charter rates are down. You're going to have more scrapping. And meanwhile, China's going to have the mother of all stimulus programs. So why don't you want to be buying? Like, maybe it's 1 week from now or 2 weeks from now, but you got to be long this thing.
Okay, well, we'll leave it there. On that note, Harris, thank you very much for joining us. It's always a pleasure, and we look forward to chatting a month from now, and hopefully things will be better.
Sounds good. Looking forward to it, guys.
Yeah, thanks, Harris.
Thanks.
Cheers, bud.
Cheers.
Bye. Okay, Patrick, it's another time for me just to sit back. I get to listen to you describe what this week in trading history.
All right. Well, this week in trading history, I wanted to go back to January 29th of 1892 when the Coca-Cola company was incorporated in Atlanta, Georgia.
Wow.
Yeah. And
I didn't realize it was quite that old.
It's that old. But what was actually the part that got me really interested in sharing the story was rewinding back even further about the origins of the formula and how it actually came about. And so we have to go back to the Civil War when John Pemberton was sustained a saber wound to the chest in the Battle of Columbus. Saber wound to the chest.
As one does when they're in a civil war.
Yeah. He soon became addicted to morphine to ease his pain because supposedly getting a saber into the chest is painful.
Yes. Do you blame the guy?
Anyway, so in a year later, in 1866, he is seeking a cure for his morphine addiction, and so he begins to experiment with painkillers that would serve as a morphine-free alternative, right? And so the first recipe that he comes up with, he calls it the Dr. Tuggle's compound serum of globe flower.
Come on. You're shitting me.
That's right.
You're making this up now.
No, I'm not making this up. So in which the active ingredient was derived from this button bush, a toxic plant common in Alaska.
Okay, I'm calling bullshit on this now.
So
button bush,
yeah,
and Dr. Tuggle's compound syrup of globe flower.
Exactly.
Sounds like something you would get like a type of acid at Woodstock.
Exactly. And so he goes on. He goes. He then begins experimenting with coca, right? And makes coca wine.
Not the chocolate kind of coca.
Exactly. Eventually, creating a recipe from kola nut and Damenia, which was later called Pemberton's French wine coca.
Nice.
So he then comes the story of how he gets to making his world famous soda, and so because back then there was public concern about drug addiction, depression, and alcoholism around war veterans and highly strung Southern women. And so Pemberton's medicine was advised as particularly beneficial for ladies and all those whose sedentary employment causes nervous prostration. And so in 1886, there was in Atlanta, they enacted the temperance legislation, and so he had to come up with some new non-alcoholic alternative for his French wine coca. And so that's where they began experimenting with this recipe in which he was formulating through trial and error. And so he basically went through this process of blending all of this and accidentally blended the syrup with carbonated water by accident. And suddenly it was, wow, this actually tastes good. Wow. And so his bookkeeper, Frank Robinson, came up with the name Coca-Cola. And so it was originally touted, his drink, as a tonic for the most common ailments based on off of cocaine from the coca leaf and caffeine-rich extracts of the cola nut. And so the soft drink originally included cocaine, right? And so many of the health claims he made for the product, touting it as a valuable brain tonic. It would cure headaches, relieve exhaustion, calm nerves, and market as delicious, refreshing, pure joy, exhilarating, and invigorating.
But all your friends would say you're talking too much.
So he then goes on, and they decide to actually sell it as soda fountain stuff, and the advertising became very successful. But as soon as Coca-Cola hit the market, Pemberton fell ill and became nearly bankrupt. So sick and desperate, he began selling the rights to the formula for his business to some business partners in Atlanta. Part of his motivation to sell was he was still suffered from an expensive continuing morphine addiction.
From the saber to the chest.
From his saber wounds. And so he then turns around, knowing that this could become a national drink. He turns around and wants to actually share the ownership with his son, but his son only wanted the money. So they ended up actually just selling out the entire business to this Asa Griggs Candler, who basically for $1,750 bought the formula, which is basically like $50,000 of today's dollars. And so he died a couple years later of stomach cancer at the age of 57 in 1988, and pretty much died broke. And so by 1891, Candler secured complete ownership and then proceeded to incorporate it, which was This Week in Market History. And the best part was, after incorporating it, they didn't remove the cocaine from Coca-Cola until 1903, another 11 years later.
Nice. Now, Patrick, I've actually been to Atlanta, and they actually keep the original formula in some sort of special room. And It's still there on the things. Lena, hop on.
Hi.
You go to Atlanta all the time. Have you gone to the Coca-Cola museum?
Yes, I have. Right beside the aquarium.
Yes, for sure. And did you go to see the formula?
Oh, no, I actually didn't go.
I didn't either because it was like a long line. So I'm pretty sure.
Yeah, I looked at the line and I said no.
My favorite whole part about this is that when you go to the Coca-Cola, you get to taste what Coca-Cola tastes like in all the different countries. And that room, and it's crazy, Patrick. There's so many different formulas, and Coca-Cola tastes different in absolutely every different country. So it's a lot of fun.
It's
so
like
make sure
Willy
you do
Wonka
it.
at the chocolate factory, but
I will. I'm going to have to make my way down there. Anyway, that's This Week in Trading History. So, Kev, it's time for the top 3 things to watch next week. And so the top 3 things, first thing I want to just ask is there going to be a liquidity event next week? I mean, with the market going into a Friday close on a nasty break like this, it'll be really interesting to see whether this becomes something like a snowball down the side of a mountain and build some momentum. What's your take?
Well, Patrick, this is one of those situations where if I say something like it's going to really crash and then it really crashes, I look like a genius. And if it doesn't really crash, everyone knows, oh, well, at least it was really scary. So therefore...
Okay, let's not make the forecast, but it is definitely the thing to watch.
It is definitely a thing to watch. I still think this flu is over. I keep calling it a flu. I should probably... I won't be as insensitive as Kuppy. But I will say that this virus is probably not as big a deal as everyone thinks. And this is the one thing I will tell you, Patrick. Although I am concerned about the short-run price action, I think that the response to this virus in China is going to unleash the mother of all liquidity torrents. So
Really?
I don't know where it is, but on some point here, there is going to be a response that is going to be monstrous. And I think you should be thinking about buying commodities and figuring out what you're going to buy when this happens, because China is sitting there. I think 2020 is a big year. It's the year of their plenum or their Communist Party. I can't remember. It's a big year. They're not going to want their economy to be sucking wind. Their response is going to be huge. They don't have to worry about how much liquidity do they unleash. They unleash whatever it takes. They are an authoritarian society. I suspect that what you'll find is that the other side of it, their response will be overwhelm any sort of negative. And I don't know. That's my 2 cents.
There it is. Kevin has spoken. Let's go on. Number 2, we've got the jobs numbers coming up on Friday next week. It'll be interesting to see whether or not we start seeing some of the deterioration. Do you think the number's going to come in line?
So, Patrick, one of the things I worry about is that even though we've got this in the top 3 things to watch next week, I wasn't consulted about this. And one of the worries that I have is that even if the numbers are good or bad, people are going to look back and say it doesn't matter because now we have the flu ahead of us. And I think that's, and to be fair to you, I think that's going to happen with all economic numbers, that they're not going to mean as much going in, looking backwards because the market's going to be so busy looking forward, trying to decide if this flu is going to be something that is actually going to drag the whole global economy down. Right. What do you think?
Well, you know what? I'm going to just go to number 1 because you've already mentioned it a couple of times, but really we have to keep talking about it. Is that, does this coronavirus escalate? And, the interesting thing is that the weekend has the chance of seeing the numbers potentially come in much higher than as things are compounding and things accelerate. And again, you're probably right that we're just like SARS. Eventually, this thing is going to get brushed off, and we're going to and the market's going to stop making it a factor. But it's going to be really just fascinating to watch whether things first get worse before they get better.
Yeah. One of the things that I kind of am confused about is why the market is reacting to every single headline about there's 3 cases in New York City or 2 cases here. Let's face it, it's here. Like, there's no doubt about it. It's here. And, in Canada, we already had it. The real question is, does it accelerate from here? But there's no way this thing is contained to just China, and it is going to get worse. But the question is, does that cause enough of an economic slowdown, and does that cause enough of a concern about the market to actually for it to feed on itself? And I don't know the answer to that, Patrick, but I do think that the market is actually on pins and needles and is too sensitive to every headline because if they're think about it kind of logically, they have to realize that it is all throughout the world by this time.
Yeah. All right.
Well, Patrick, if it ends up being like a zombie mutant thing and and we're sitting there and I said all these kind of things to make it seem not quite as bad, I'm going to look pretty foolish.
You will. I'm just going to sit back and watch you self-destruct.
Yeah, but one of the things about this, it's like how they say, I think there's a story about in front of the JFK when they were having those issues with the nuclear kind of escalation with Cuba over the missiles in Cuba with Russia. One of the guys, it was a Friday night when the market had sold off and some people were selling, and this one trader went long into the Friday night, and they said, "Why are you doing that?" He says, "Well, if I'm wrong, there's no world around anyways. So I might as well, be long going into the weekend." And I'm beginning to feel like that. I might look like a fool. There's a very good, chance that this,
very good chance.
Very good chance. But there's little parts of the market that I actually really kind of like because I think that they've taken out and shot some of the parts of the market, whether it be copper, or whether it be oil or, shippers like we talked about with Kuppy. I think there's some real bargains out there to be had if this thing doesn't end up being as bad as everyone is expecting.
All right. Well, you know what? Let's move on to the parting words of wisdom. And this one is one that I wanted to quote from Mohit Bansal. And basically is that both bull and bear can be your friends. And the thing is that a lot of people are feeling a little bit of pain here. But sometimes you have to be friends with the bear. No?
I agree. You should be friends with the bear. I'm not as convinced as you that the bear is cuddling up with us. And
I love it. I want your. You know what? this is exactly what I need. Because if you came in here agreeing with me, then I'd be really nervous about my short.
You're right. You should. That's the best thing that's ever happened. Is that you that I am not embracing the dark side with you. But I'm acknowledging that there's a real potential for it to get a lot worse. And my God, if it's like the 1987 crash where Friday and everyone was talking about how it was over, and then the real selling began on Monday, I'm gonna look like a heel. But anyways. I think those are wise words. Both bull and bear can be your friends.
All right. Well, so at this part, we're going to bring in the uranium second half conversation with Mike. So let's get that in here. Continuing the conversation with Mike on uranium.
So now you're at these $1 billion hedge funds, but now you're off on your own. How did that work?
Yeah, so I had.
What's it like working at a smaller?
Well, that's great. So I had after my daughter in 2015 became very ill, and at this time the firm I was a partner at was morphing into a family office. After many years, the partner was winding it down. And I wound up. My daughter became very ill, and I said to my wife, I'm on the road all the time. I'm traveling. I'm just gonna chill. I'm gonna relax. I don't want to be part of, that next generation that was going on there. And so, I don't know. I was still, I'm still relatively young, and I said, okay, I'll just relax and manage our own money, and we'll see what happens from there. And I want to be around because, I was weekend dad. When you're traveling a lot and you're working a lot, I wanted to be more ingrained into the kids. And I was freaked out when my daughter got very, very ill. And so that's what I did. And then thank God my daughter started to get better several months later. And my wife basically said to me, okay, you're driving me crazy. Yeah, we've been married.
My wife says
at that time,
too.
We've been married 20 years. I've got the house routine down pat. You got to go find something to do because you drive me nuts. So basically, I just started. I was starting to get more as my daughter started to get better. I was more involved in just looking for my own investments. What's interesting, and it was really the latter part of 2015 where I read something, and I really don't remember what it was, and I read something about the uranium and nuclear power sector. And I know me, my desk has a lot of papers on it. I'm a paper guy, and I print something, and it sits there, and then I probably read 20 other things, and then if I go back and look for it, and I come back and say, where was that thing? I want to read that again. And I found myself doing that with uranium, and it started to really intrigue me. And if I think I sent Patrick something. If you were to look at that chart on page 3, Patrick, that one up from there. That. Well, at the time I was looking at it, I think it was down it was around 80-90%. And I said, well, that's interesting to me, But at that time, I didn't really know much about uranium. Back in 2007 at the peak, and 2011 after Fukushima melted down, my team, I had them look at it for a very brief period of time, but we had a full plate going on, and they said, look, this is pretty complicated, it's pretty opaque, so we didn't spend much time on it. So I really didn't know much, but I knew enough to just keep coming back to, why is that down so much? And uranium is, it's the feedstock for nuclear power, but I'm really not that sure about nuclear power. And that was really like the latter part of 15 and early 16. And I just kept reading about it. And I made the decision. I said, I have time now for this. So when you have a portfolio of stocks and you're managing other people's money across a diverse set of industries, and you have a number of positions in the portfolio, not a ton, but a fair amount, and you have analysts that you're working with, you don't necessarily have the time to dive into every new idea you see. But now I had nothing but time. So I said, okay, I'm going to take the time to learn about nuclear power. Let me understand it. And really the only point of reference I had on nuclear was, I knew wind and solar were were on fire, and there were always component makers. And early on in the early days of these big growth industries, there's some interesting short opportunities because prices get way out of whack. But again, I was on the periphery there. But I said, let me understand the role of nuclear power in this new power generation world. Where does it stand? And I started to reach out to some friends who were working on the buy side. And I said, get me some models if you can. Let me see what's going on. Let me look at the sell side, the analyst models on some of these uranium companies and any nuclear power stuff. And what I started to realize when I started getting the research to me, that the uranium mining research was stale. It was dated. It was old. And there was not a lot of information. And it kind of made sense to me because when you see an industry implode like that, what you're typically going to see is those in a niche industry like that, those analysts get fired because they don't generate commissions, and that's not a profit center really for the bank. So you had dated research. What really started to intrigue me a little bit was, wow, look at this. The market cap of the industry at one point was over $150 billion. And when I started looking at it, it was, if memory serves, $4.5 or $5 billion. And I said, wow, so the commodity price is down 80, 90%. The number of companies went from 500 who were doing uranium at the top down to, I think it was 50. The market cap had imploded. The sell side is gone. What if this is a perfect, could this be a perfect hiding in plain sight type thing? And I didn't know. And I said, let me look. So as I started to read about nuclear power, I started to read the importance of nuclear in the world as a baseload source of energy. I started to look at it compared to wind and solar, and there is a role for wind and solar, but its intermittency is somewhat detrimental to it. To store the power is very expensive, and I'm going back now. Those costs have come down, but they're still quite high. And as I started looking, I said, I think there's a complementary role here versus the other. And this was before Greta Thunberg. This was before nuclear power clean air. People are cognizant of it, but it's taken on a life of its own the last couple of years. But at that time, I said, okay, let me just kind of figure out what the demand drivers are, because what does it cost to produce a pound of this stuff? And as I started looking at that, because the research from the sell side was current and the market cap had been destroyed, most people don't like catch falling knives. They don't like catching them. So the institutional ownership was gone, which to a value guy you kind of like. But I also, because of that, I said, let me kind of put the number who uses these reactors. Well, how many are there? Well, let me go find that data. Well, when are they licensed until? What types of reactors are they? How many do they use in a year? How many for this? And what's the cost to pull it out of the ground? And when I saw $45, $50, I said, wow, what's the price? The high teens, low 20s? How long can that last? Right? Because if the cost to pull it out of the ground is twice what it's selling for, something's not right there. That doesn't last. And the question is, what makes it change? And so as I started to put a spreadsheet, really open up an Excel spreadsheet and start going through every reactor in the world and how much will they consume each year. When I did that, it's a tedious effort because it's hard to find that. It's not hard to find, but you've got to compile it yourself. You've got to take the time and to do it one by one. And when I did that, I said, I could pencil out a scenario where this thing, nuclear power, can grow 2 to 3% a year, and it's being priced as though it's going out of business, and it's 12% of the world's electricity production. It's 20% of the U.S. electricity production. Something seems disconnected here, unless I'm missing something, and I very well could have been. And so, but that was enough throughout early part of 16 for me to start to really say, okay, I could see a demand picture here. And when I looked at what the old models were, I thought, wow, they're pricing this as though it's just done. It might be a negative growth business. And I don't see how that is. And I took a list. Of these 30 countries producing nuclear power, when are these when are these reactors scheduled to shut down? What's the chance they'll be relicensed? And you have to read a lot and talk to people because every country is different. What's the competitive environment like? Is it the U.S. where half the electricity markets that nuclear power produce in are unregulated and it's open to competition? Well, that's somewhat of a challenge. And then what's each environment like? And again, I had time. So I dove into it, and it was a great exercise. And I concluded on the demand side, you know what? I think the market, whoever the market is, because the sell side's really not forming a consensus, I think some of the estimates out there by the industry, quote, experts are wrong. I think they're taking a recency bias, and I would start to read some of their information. I would get my hands on it, and I'd say, wow, this is mired in what's happening now, not what needs to happen. And then it was also mired in you can't avoid the fact that that most of the production was being produced well below where it cost to extract it. And so then that sent me out on an errand to go take a look at the supply side. And then I started doing the supply side analysis. How many uranium mines are there in the world? How many uranium, what do they produce? How much have they been producing over all of these years? Are there other sources of supply? Yes, there's secondary sources of supply. Well, what are those drivers? And as I started doing that, I started to learn more and more about the secondary market and government programs that were put in place where the Americans, the world was worried after the wall fell in the early 90s that the Russians would take many of their intercontinental ballistic missiles and sell them in the black market. So they put a program in place to downblend the uranium, which was highly enriched for bombs, and downblend it for use in civilian power. And there was a deal in place from 93 to 2013 that flooded the market. And then you had the Fukushima event, which also added more uranium. And the market started saying, well, until the Japanese come back online, there's too much uranium. And I thought, well, it's got to be. And it turned out there was. And so it wasn't just about Japanese restarts, because in my modeling, I never accounted for many of them coming back online. And what I saw then was, wow, there's still too much supply here. But if you ever got a production cut, you would have to, the market would start to re-rate. You need to see supplier discipline. And I couldn't figure out what struck me as odd in looking at the analysis is as I was looking at the production numbers, I said, okay, Fukushima melted down in March of 2011. Why were the uranium miners producing more uranium in 12, 13, 14, 15? Why were they doing that? And what I came to realize in peeling the onion back on the market structure is most of the miners were protected under very long-term contracts because fuel buyers were worried about security of supply because there's no substitute for uranium, that they typically would contract for 7, 8, 9, 10 years worth of supply at one time. And as I started looking at the contracting numbers, what I realized was, well, something doesn't make sense here. Why were they contracting 220, 40, and 50 million pounds a year during peak pricing when prices were, that's $130 a pound, 137, 125, 120, 110. Why were they contracting like there's no tomorrow at those prices? And yet when the price of uranium was $20, they weren't contracting anything in the early 2000s. And so what I realized, and we could talk about this, the structure of the market, but what I realized was the miners were producing because they thought they were covered under long-term contracts, and they figured the market would kind of come back to normal. And there were a few tweaks that caused that not to happen. And so as I started really in 2016, now I'm getting into the latter part of 16, I said, wait a second. They're not going to have a choice. They have to cut supply. You can't produce, no matter how good a CEO you are, you can't produce something for $45 or $50 and sell it for 20. And these contracts were starting to roll off. And as soon as I saw they're starting to roll off, I said, well, that's where they'll be forced to have discipline because they need to pull supply out of the market because they won't get the price they need. And so one thing led to another, and I spent really I don't know how many thousands of hours in the latter part of 15 and 16 and really understanding it. And then I started going to nuclear industry conferences where I could go talk to fuel buyers and I could talk to producers and I could talk to people who traded the commodity. And my head would hurt throughout 2016. I said, my God, this is by orders of magnitude the most complicated thing I've ever looked at. Not even close. And then but that started to get me really excited because I said, if the industry's left for dead by Wall Street, and if it's left for dead by pretty much everyone, but it's really not left for dead by those who need clean baseload power, and it's going to keep growing, there's an opportunity here. And so that was kind of my really strong period. And by early 2017, I think it was January of 17, we saw the Kazatomprom, the state-owned entity out of Kazakhstan, the number one producer in the world, they cut their production by 10%. And I said, aha, this is the one and I had been reading a lot and listening to people talk, and they said, well, the Kazakhs are state-owned, it's a lowest cost producer in the world, they'll just keep pumping it out. And I had started looking through, and at that time they weren't a public company; they were a private company. But they had debt, and because of that, they did issue an annual report. And as I was able to glean, going back many years through their reports, I said, this isn't really as low a cost producer as people think, because one of the things I noticed was that they had their costs. I thought the best I was able to piece together were quite higher than. Now in early 17, where people were thinking about they were. And then I looked at the currency, and I noticed that they had devalued the currency significantly, dramatically against the dollar. And I said, oh, well, of course. They cost in tenge, and they sell in dollars. So their costs, as the price of uranium is coming down, people think they just happen to be this wonderful low-cost producer, and they are. But not nearly as much as people think they are. They're getting a huge boost from the currency here, because when you cost in tenge and sell in dollars and you devalue your currency, you benefit from that. Yeah. And that really was a big margin aid for them. So I started to just put that mosaic of information together, and then we started to see throughout 17. And that's why for the first time, I shared this with a former boss of mine. And I said, am I missing something here? And he has a lot of experience in the natural resources space. And I looked at plenty of resource companies, but I said, I want to get a clear look here. I feel like I've got to be missing something, because the supply and demand numbers, I could see that the supply has to come offline. Demand isn't as bad as people think. Tell me what I'm missing. And I sent this to my buddy, who I used to work for, and who I have immense respect for. And he's retired now. And as a young man, he retired. He had a very successful hedge fund and closed it down to focus on his family. And he came back to me, maybe a month later. He said, "You're right. This is asymmetry here." And so we talked it through, and that's where. He said, you should start talking about this to people and solicit feedback. And I appeared on Real Vision TV. He knew somebody there, and they were interested. And I gave this presentation, and then that got picked up by some natural resource conference in Vancouver, who said, hey, that's an interesting thing. Would you come out here and talk about it? I did, and I shared my views on the geopolitics of the uranium market, the risks inherent in the geopolitical landscape, and where a lot of the production comes from, being Russia, Kazakhstan, and Uzbekistan. And I noticed that the U.S. was buying 99% of its uranium from foreign sources, and half of that at one point was Russia, Uzbeks, and Kazakhs. And I said, wow, how's that possible? I guess it's possible, but there's a lot of risk there. And so I shared that. And that started to gain traction. And then...
So, Mike... Yeah, so what I wanted to just kind of dig a little deeper. So obviously, it's been a story that you've been following for 4 years or more. 2016, I was out at also speaking at the Vancouver Resource Conference. So I always hear these uranium investors out there, but I mean, we're lacking clearly a short-term catalyst. I mean, it's been 4 years of a lot of the same thing being repeated over again, but yet we haven't seen that catalyst that has really set in motion. Turning of the tide. What do you feel will be the trigger?
Well, it's a good question, Kevin. But you haven't heard these same catalysts that we talk about. I've seen those conferences and those presentations, and quite frankly, they're pitiful. I don't know how somebody, to be truthful, I'll be as frank as I can. Some of the biggest issues in the market nobody was talking about, which is underfeeding, which is a secondary source of supply. And so what you had in the marketplace was essentially what's the equivalency of shale production and horizontal drilling in the world of nuclear power. In the world of oil and gas. You had kind of a similar change take place in the 80s and 90s in the nuclear power industry at the enrichment phase, where, but nobody talked about it. And what I mean by that is, when you did horizontal drilling and you were able to start getting a lot more production out of it, get through the tight oil, right? And you were able to produce like crazy over the last decade here in the U.S. That was a technological shift. What happened in the nuclear power phase, and I didn't see anyone talking about this. I stumbled upon this back in 16, was underfeeding. And what that means is, I won't get into the physics of it, but at the enrichment phase back in the 80s and 90s, they went from gaseous diffusion technology to centrifuge technology. And it was just the way the technology they used to enrich uranium. It comes out of the ground in its natural form with an energy content of 0.7%. And it's got to be enriched up to 4 to 5% for nuclear power, and it goes to 90% for bombs, above 90 and above. And as I started looking through that, what you realize is that the cost per kilowatt hour to keep an enrichment plant open using a centrifuge technology is 98% less than it is to run a gaseous diffusion plant. And so as those plants were being wound, as Fukushima, when it melted down, you had a lot of excess capacity in the world. So you had all these centrifuges with separative work units is the unit of work it's called, excess capacity. And the way it works is they're allowed, the enrichers can extract more uranium, enriched uranium product for an order that it actually calls for. And as long as those centrifuges are running, they keep them running. The cost is very low. The marginal cost is very low. And they're able to substitute really mine supply, if you will. And they were doing that to a significant amount when capacity went offline. And people it just wasn't being discussed. And so we started to really understand and dive into that side of the market and understand the math involved and the tail assay assumptions that are used. And if lower tail assays are used, what does that do to SWU capacity? And so as we started seeing all of those, I started to conclude in probably early mid-17 that there's a very finite life to this excess supply coming into the market, because that capacity will be sucked up. And you fast forward today, and it's dropped off a cliff, and underfeeding.
It has, right?
Yeah, and so when I see the old bull cases, they were, and I hate to say it, they were uninformed. If you were they were horrible. They were bullshit. They were ridiculous is what they were. If you were buying these stocks in 14, 15, 16, and 17. And so why was 17 an important year? And why did I start Sachem Cove in the middle of 18? Because of a delivery waterfall that starts to, in the prior period, like I said, you might have had 40, 50, some years, 20 million pounds of contracting in the late 90s into 2000s. And then in 2000s, when Cigar Lake flooded in October of 2006, you saw the market, you saw people, fuel buyers go in and panic. And they were contracting at 210, 240, 250 million pounds per year of uranium, like I said, versus what might have been 20, 30, 40 million pounds a year. And those contracts are 7, 8, 9, 10 years. And as I started looking at the delivery waterfall, right, you have to lay out how many pounds were contracted, over what years were they coming into the market, when does that fall off? Well, that started to decline at about the 17, 18, 19, 20 period. Well, the fuel cycle is 18 to 24 months. From the time I say, hey, Mr. Miner, I need some yellow cake, and the time it goes through that process, that's how long it could take. So I said, okay, well, we're starting to get into a period where we're starting to see deliveries start to fall off. We've had a lack of contracting. We've had tremendous under-contracting versus consumption for quite some time. And so I said, well, that math is starting to get interesting to me. And as I started to look at, the producers and how much they were contracting, and I said, wow, this is interesting. You're starting to see them buy. How much are they buying? They're buying a heck of a lot less than they're consuming. And I laid out the math, and when I did that math, I said, wait a second. They've got to start coming in. They were always contracting, but not a cycle, not coming in mass. And as you start, right? Yeah. So I said, okay, so now you're up against supply is being cut. And then it starts to, you got to start really peeling the onion back on pricing, right? So what is the price of uranium? You're seeing that thing, that's the spot price that I'm showing you right there. The spot price is total bullshit. And so there's two prices. There's the spot price and there's the term price. And the term price is what triggers the long-term contracting. Now, the long-term today, for instance, the spot price is right around $25, and the term is 30.
What page do you want me to be on?
Yeah, let me go. Let me pull up what page you could go on for that. Let's see. Do I have term on here? Yeah. So go to. I'm just trying to see what I sent you. Just bear with me. Just hang on a second.
Yeah.
I'm just pulling up so we're on the same page because I'm looking at my bigger presentation that I use for investors. Okay, here we go. So if I go to, if you take this down to, here, go to go to page number 4.
All right.
And you'll see a green line going across. If you look at that math, 65% of the global producers today don't make money. They lose money at today's prices. If we look at there's roughly 190-ish to 200, averaging 196 to 200 million pounds a year of demand over the next several years, and we're higher. I'm talking where consensus is. We're not monstrably higher, but we're one consensus is 170 something, but the World Nuclear Association, which is much closer, is about 196 a year for the next 10 years. We're higher than that.
So Mike, we had a mutual friend, Harris Cooperman, there, Kuppy, on the show, and his way was wanting to play it through the uranium participation unit. He was going right after the investing in the uranium price itself. What's your take? How do you play? Do you play the uranium, or do you play the individual stocks? Like, do you go after a Cameco? Like, what's your way of approaching investing into?
Yeah. So well, you got to understand what. So go to slide 7. You asked why now, right? And then we'll talk about how you express the view. Slide 7 is a chart with a lot of lines on there, and you'll see the first Kazatomprom cut was in January of 17, and then the stock had a bit of, the sector had a bit of a move, but there was still oversupply, right? The market's not completely stupid, and then it came up and then it started to move up again, and then MacArthur River from Cameco, they announced in November a big shutdown. And what we started to see in that fourth quarter of 2017 was something you hadn't seen in a while. You started to see multiple utilities come into the marketplace to go in and start to contract for uranium. And that was a good sign because you said, okay, they're starting to get off their pants, get off from sitting and starting to get off their hands and start to come into the marketplace. And that you would start to have price discovery. Now you had two big producers cutting supply, and you would start to see real meaningful pounds being put out to bid. And those take several months to negotiate. It's not something you don't just say, okay, here's the bid. They go back and forth. There's many rounds. They could take, in some cases, a few months to 6 months. In other cases, a couple of years. That's how long a negotiation can take, because you're talking meaningful pounds being negotiated. And then you'll see that little blue line in January of 18. You've had something that has cast a pall over the market for quite some time. We had two small U.S. miners filed a Section 232 petition in the United States. And without getting into a long, drawn-out explanation, it was very simple in the sense that the 232 petition was two U.S. miners asking the U.S. government to investigate the basically dumping of uranium by the Kazakhs, Russians, and Uzbeks, and asking them to recommend to President Trump that the United States nuclear power plants buy 25% of their uranium every year from them, from the U.S., versus the 1% they were buying. When that happened, those bids got yanked, and people sat on their hands. And then, so the process was the Department of Commerce did not need to even investigate. They asked the Department of Commerce to investigate, but there was no timeline as to whether or not they would investigate. So the market, the buyer said, well, wait a second, we don't know who we're going to buy this uranium from. Are we going to be mandated to buy from U.S. guys? And that really put a pause on the market. And that it took 6 months before the Department of Commerce even agreed to investigate it. And then it was another 9 months that they had to investigate, and they took every single day of that 9 months. And we at Sachem Cove happened to be a source for them. They reached out to us and asked us to provide some insights on the Russian, the Kazakh, on the fuel cycle, which we were happy to the extent that we could. And then that turned into more time. And then over the summer in July, Trump said, I don't think it's a national security risk, but the U.S. fuel cycle is at risk. So I want to put in a working group, and I want this working group to be, it's basically made up of the cabinet, to investigate and come back to me in 30 days. And then it turned into 90 days. And then that turned into another 30 days. And then here we sit today, not knowing the outcome. It's more likely.
Right.
Yep. So you're asking,
Mike, it's
yep.
Kev here. So that actually expired today, did it not?
No. Those are waivers. That's a different. Those are waivers that the government has waivers against Iran, and they sanction, and there are sanctions against Iran. In nuclear power, they have given waivers to those who do business in the nuclear power space in Iran. And it's very meaningful. It's completely separate from this trade policy action, though. Very different. And that's created this overhang in the market because you haven't seen wholesale contracting. But however, with that trade policy and that lack of wholesale policy, you've morphed into 2020, and you've got a couple of issues. It's now every 60 days, but it was every 90 days that these waivers would come up for renewal. In other words, is the U.S. going to sanction any company that does business in the nuclear power space with Iran? And if they do, that would have really big implications because Rosatom, the state-owned Russian atomic energy company, does business there. And the U.S. buys a lot of enriched uranium from them, from their subsidiary. And if that were to happen, it would impact how much fuel the U.S. buyers can get from them. They've already had purchase agreements with them. They would have to scramble and go out to get them. The U.S., the European utilities, all these contracts are priced in dollars. Even if they went to price them in euro, the European banks won't touch it because they don't want to be sanctioned by the U.S. Right. So, but every 90 days it comes up for renewal. Now Pompeo is saying no more waivers, but Mnuchin has won the last couple of rounds, right? But that's neither here nor there. What it magnifies, though, is the number one concern a fuel buyer has is security of supply. And you ask, why now? Why now? Why tomorrow? Why 6 months? But why not 2 years from now? Is because it's about inventory drawdowns. And because of this lack of contracting that's taken place over the last 7 or 8 years, because of that lack of contracting, the U.S. utilities, the European utilities, it's been a sucking sound of inventory that they've been drawing down. When you go back to the last, as the last cycle was turning, the commercial inventories in the U.S. were about 2.5 years or so. You're below that right now. The Europeans were 2.7. You're below that right now, and you're at a point.
But Mike, why is the spot not responding?
Because
yet?
spot's a bullshit market. Well, you're asking spot is a nonsense market, and here's why. Spot market normally trades 40 million pounds a year, 30, 50, but 50 is a big number. In the last 2 years, it's traded 89 million and 62 million pounds. In a given year, 65 to 70% of that are traders churning pounds back and forth. I'm selling 100,000 pounds to you for a quarter. That's what that market is. The utilities coming into the market are a tiny portion of that. The producers buying above their delivery book are a tiny portion of that. It's the best offer market, not a transactional market. What's the offer? These are churned pounds by traders trading for scrapes. That's what that is. That's not real demand.
But why wouldn't a utility come and buy a Uranium Participation Corp, which owns all that uranium, and just say, okay, I can buy this for half the price of the kind of forward contract? Is it just not big enough?
Well, they have what, 18 million pounds. That's what that would be. One utility that's using a couple of million pounds for 10 years, you've got 60 utilities in the world. It's a meaningless number, what uranium participation has. That's a way to play a net asset value play is what UPC is, right? So is it traded at a premium or a discount? What's the premium going to trade when uranium's ripping, and what's the discount it trades when it's not? Today I think it's at a 10% discount. Right, but in the world of pounds, it's meaningless, right? They're contracting when the cycle's turning. They're contracting 200 to 250 million pounds a year. They own 18 million pounds. It's a rounding error. So UPC is not.
Okay, so that's basically it's just too small, and it's just like an orphan.
Yeah, and they don't buy spot So people look at spot and they say, well, why isn't it moving? The question people should be asking is, go to the next slide. It's slide number 5.
Right. Okay. Uranium spot price since the bottom.
Since then, it's May 17. Now, so somebody who doesn't believe the cycle, they would say, well, why isn't there's too much supply out there? Well, if there was so much supply out there, you would see the prices continuously making new lows, and it's not. It is up almost after that. That's a month old. It's up over 40% since the bottom. You've had trade policy action that's created. Now that's just spot, right? And you've had no demand in there. 65-70% of pounds being traded in the spot market is not producers. It's not utilities. It's traders. Those are literally pounds that switch back and forth. They're 150,000 pounds. So and these guys don't take a view. They're trading for what can be 25 cents a pound or 20 or 15 cents a pound. And that goes back and forth and back and forth. Right. The amount of pounds physically delivered in 2019 was 10 million pounds. Now that's in a market whose demand is 190 million pounds and whose supply, primary supply is 130. So they're meaningless pounds. Right. Now the price that
Right. Okay, so Mike, how do you play this then? So if you don't buy the spot, or you can own the spot, that's one way. Yeah. But for big money, how is this going to manifest itself? So it's an opportunity of a lifetime in that this thing's trading way below the cost of production. How do you go out and put on a trade that, at 5 years from now, you're going to wake up and go, I'm glad I did this?
Well, the first thing is understanding what the price is, because the next leg of that, you have to understand this as to how one wants to express that view. The second price that is the one the utilities are going to key off of is the term price. That's the long-term contract price. Anything that starts over 3 years. That has been and the average price when the spot price was $137 back in 2007. Utilities on average were contracting at $90 a pound. So today that price is $32 a pound. Now that is still meaningfully below what you would pay what it costs to produce a pound of uranium. And if you were to look at all of the producers, if you said, okay, let me go and look at all the tier 1 production that's out there that people think can produce at these prices right now, that's about 42 million pounds of uranium in a market that needs 190. And then you say, okay, let me go see all those pounds that if they didn't care about profit, that could, and they just wanted to break even, that can produce at today's spot price or long-term contract price. Long-term contract price, you're around 80 million pounds, right? We're still not half of consumption. So the term price is sitting at 32 is not a real curve. Now, why is that? So how can that not be, right? You and I look at commodity markets all the time, and the price curve is the price curve because of the reporting methodology of the price curve. It is very unique to uranium is it's a best offer reported price. And so what people don't see is what's happening in the off market. And what they don't see is that there are contracts that are signed at higher prices than the term price with a 4 handle that don't get reported by the price reporter. Well, how is that possible? Because these are negotiated contracts that go back and forth and back and forth. And if somebody were to come in with a lower bid that knows they're not going to get those pounds, so why would a utility buy pounds with a 4 handle when term pricing is 32? Because it's not just about the price. It's about security of supply. Is this a producer that we know has a producing mine or will be in production that will produce? Are there environmental, ESG, environmental, social, and governmental issues that we need to be concerned about? Are there limitations on origin of where this uranium comes from that we need to adhere to?
But then, Mike, shouldn't then we speak? Sorry, I'm sorry to interrupt, but shouldn't then we be seeing that in the numbers? Shouldn't why
numbers?
shouldn't that come through in the
numbers
accounting?
Would you?
Well, if they're doing trades at 40 and like in essence selling at 40, even though the reported market is in the 30s, as they report their profits going forward, you should start to see it, shouldn't you? And shouldn't the companies disclose we just sold X amount at $40
well, I'm
or
glad
whatever?
you asked, because then that goes to the opacity and understanding how the uranium market works. In every single contract, there's a non-disclosure agreement where unless they waive it, and it's very difficult to get waived. A trader might come out and say, we signed a contract. Itochu and Mirabini will come out and say, we signed a contract with the Uzbeks. But between a utility and a producer, no. And if anyone was paying attention, they would have listened to the first quarter Cameco call where they signed 25 million pounds at a price they need. Read their 43-101. They need $43 a pound. And then even further in public discussions, they've said they're signing with a 4 handle. So when you think about that, but market's choosing to ignore that because the term is staying at 32. Well, why is that? Because it's a best offer. If you just think about what that means, somebody can offer a lower price, it gets signed at a higher price, and it does not get reported at the term as the term price doesn't move. And the price reporter will say, well, a rational buyer would have paid that lowest bid for it, which is beyond ridiculous. The rational price is where a deal got done.
Right, I hear you. You're basically saying there's some crappy company. It's like somebody on Kijiji or eBay offering something, and you're worried they're not going to be able to deliver that what product. Right?
You're worried,
and so therefore you have to ignore that.
You're saying you're going out and saying, okay, I make it up, right? I need 2 million pounds a year for 8 years. I'm making it up. I need to know that I have surety of. I need to go to bed at night as a fuel buyer, knowing that that's the price I'm paying. Now, that's starting to take place and has been taking place. The pipeline of those conversations in the marketplace are occurring.
So you would argue the turn has already happened. It's just that we don't realize it. So therefore, is the best play to go buy the Camecos of the world?
That's a great question, Kevin. It depends what one's risk profile is, right? So if we go back, and unfortunately I don't think I put that in there, but in these charts, but the price of uranium is up even from the 232 petition filing, where all of this, they've gone on pause. It's up by, I'm going to say 8-9%. I could be wrong, but that's about roughly what it is. While the equities are down 25%, right? The equities are down 25%. So somebody has to have a risk profile to understand how do you have a disconnect between supply destruction, demand that's come out. The World Nuclear Association in September came out with their demand numbers. And for the first time in 8 years, they raised their profile. Now, we can get into a whole other discussion about the forecaster in the business and how we spoke publicly against their numbers back in October. And those numbers have come up to what the market might not even know because it's hidden behind a paywall from a subscription that is a fortune to buy. Is the main forecaster in the industry took their forecasted deficit in late November from 2026 down to 2022. And it's easy to argue against down to where it's now. But even if you believe the 2022, the fuel cycle being 24 months, here you are. And so but these fuel buyers are not. So what you need, though, to see more wholesale changes is it's like in any business, it's the 80-20 rule, right? So 20% of the people do 80% of the work. And so those who are doing their own analysis, you got to remember the cost of uranium is single digits as a percentage of operating a plant. If you are operating a coal or a natural gas plant, it's 80 and 90% of the cost. So now you get to when you start to see more of these deals start to cross the transom, and all of a sudden that term price has to move up because you don't see it in their P&L because they don't get delivered. These are long-term contracts. By definition, deliveries don't start for 3 years. And so they don't –
I get it. So there's the key. So even if they sign a 40, it really doesn't start printing at 40 till 3 years from now in the accounting. And the fact that they're not allowed to announce it and it's these non-disclosures that you don't really realize the market has already turned.
You said it better than I said it. And so, and why has that happened? It's happened. So now the spot price, the crazy thing about uranium is people only really have a spot. They can't see the term unless they subscribe to these price reporters. They stare every day at this futures contract, which is basically non-existent, but they look at it, which is keyed off of spot in a market where over 2/3 of it is just churn, is trader churn. And producers are buying a little, right? The volume of physical delivery uranium is nothing, and it's 10 million pounds last year. So now, how do you play this? Now, it depends what one's risk profile is, right? So if where do we view? What does Sachem Co view? I see a lot of people on Twitter. They think, they look at the last cycle and they say, well, these stocks were up. Everyone goes to a stock and they say, oh, it went from a penny to $10. It went from it was up 50 times, 30 times, 50 times. We don't think that exists. We think there's really big upside in some of the equities. But, a lot of these companies have diluted themselves to kingdom come, right? So you have to take that into account when you're looking at valuation. So we think they're...
Well, not only that, Kuppy talks about the fact a lot of them are just holes and swaths of lands with some uranium and some, a resource estimate about how much is underneath.
Absolutely.
And they're speculating on that. And really what you should be doing right now is buying the people that are producing. Should you not?
Kuppy and I are good buddies, but Kuppy likes to tell people what they should be doing. I don't like to tell people people should be doing what they want to do. And Kuppy, if you're listening,
okay, well, tell us what you're doing. What are your
Kuppy and I we chat every day. And Kuppy's got his view, but Kuppy is a crazy smart guy. Made a lot of money in the last uranium cycle. He doesn't live in the uranium cycle, though, right? We live in the fuel cycle, and there are a number of companies that do that, right? That they play the pounds in the ground game. They go out and acquire pounds, and why do they do that? Because the lazy way of analyzing pounds is EV per pound in the ground, right? So, what's the enterprise value of the company? How many pounds do you have? But the question you got to really peel the onion back on is, how many of those pounds are economical? How many of those pounds are bullshit pounds, right? But people tend not to do.
Right, because you still need to make a mine. If you don't have a mine, then it doesn't matter how many pounds. So give us
if you're looking just to do that. So if somebody says, look, I think that I want to. Where do we think? We think the price of uranium does it get to 100, 125? I have no idea. I don't worry about that. What I worry about is where it needs to get to. Right? Where does it need to get to to incent production just to meet that get close to meeting requirements, you're looking at around $55, $60. Now, people will look at that, Kevin, and say, oh, well, the Kazakhs can produce. Well, they don't do the math. This is fourth grade math. You got to look at how many can produce those pounds and at what price. Even those tier one production pounds right now have a 68% utilization rate. Why? Because they're not making anywhere near the money they need to make. Point is, that's where, does it need to get to 55, 60? We think so. Now, here's the thing. This market is so ridiculously opaque. The fuel buyers, the average guy who, even now, if he's forward-thinking, or she, and wants to go secure pounds, they've got to walk into their chief financial officer, their chief nuclear officer, or their risk manager, those are the three, and say, hey, Bob, I want to buy a $55 contract today, term is at 32. Now, unless they have real sway, they're going to say, sorry, Bob, sorry, Jim, its term says 32. Yeah, but it's not really there. Well, I need to see it published higher. Well, as those deals, which have the demand and the pipeline of those deals, as more of those start to come, the price reporter has no choice. They can't say, oh, it was a random 25 million pounds. Now it shows up, right? So what happens, though, is because of that lag, because of that delay, and because the market's not paying attention, because it's left for dead, no institutions are there, what winds up happening is 55 becomes 65, becomes 75. And then if you go back and look at historical purchasing patterns, it's crazy. You ask yourself, how is it possible that at the peak you're contracting two times your consumption, when at the bottom you're contracting 40% of your consumption? What are you doing? But that's the market, right? So now, here's the thing. People will be romanced by what they think are generational, life-changing returns, and in some of these companies there are. But in some there aren't. You've got to know if you're playing the equities, you have to know which ones are the real companies and which ones aren't. So when you look at producing,
okay. So which ones are the real ones, Mike? We're going to put you on the spot.
Because I don't talk company.
Oh, you're not okay.
Oh,
I get it. You're not allowed to.
I can, but I don't.
I understand. You're actually have compliance issues.
Well, no, I don't like to promote any companies because it's not. I don't like to promote companies. That's not my thing. We own.
Well, okay. So let's talk in general. Would you not agree that you're better off with companies that are actually producing and that aren't as speculative?
Well, so I'll give you a flavor for the composition of our portfolio.
Sure, that'd be great.
So, we believe that there are those that are just some really world-class assets that will need to go into production that have great economics, and those would sit towards the top. So they don't have to be a producer right now. They don't have to be going into production tomorrow for that to happen. But we think the disconnect between the value, and we don't value based on what a CEO says. We do it based upon project economics and based upon what we think a company is inherently worth. So there are a couple of really terrific, great world-class type projects that we place great value on that would have a higher percentage of our portfolio. We also place great emphasis on those who have produced before, are producing now, might be on care and maintenance, or are close to going into production. That's very important to us also, besides quality of asset, is because when the market turns, markets like companies that go from cash consumptive to cash producing. And when you can go from...
Right. So you're actually almost looking for the higher cost producers that aren't producing right now because it's not efficient. Not a higher cost producer. The stuff the higher cost miner that is actually not producing, that will, once the price comes up, will actually kick in and give you the most leverage.
And that's higher cost has to be defined, right? So tier one producer, like a really, really low cost producer, is there's something interesting there. But you need those tier 2 pounds. They need to come in. those tier 2 pounds that can produce or
Right.
near development, those need to come into the market. And again, we have to look out over 10 years because that's what the contracting cycle is. So we need to look and say, well, who's
Right.
going to come in? And then really it's right. It's doing your project economics on a project by project basis, and what's the cash flow of that project, and discount it back, and what's it worth. So yeah, we're now.
Right.
I will also say, for some people who love to just purely speculate, some people say, I'm going to go to the highest cost potential ones down the road because they're going to get the biggest bang and they're going to get a ton of leverage and people are going to go crazy for them. Or I'm going to go find that tiny exploration company who's been out there for years looking and looking and looking. What you tend to see is when the market turns, these things go parabolic, right? But that comes down to risk reward. Are some of those donuts? Probably, if the market didn't turn right away. But will some of them have really big exponential price increases? Are some of them heavily promoted? Yeah, we stay away from those. There are a few of them that we will, where we'll do a little bit of a financing, just like anyone else could do. We'll do a private placement where we can get some warrants that might extend
Right.
3 to 5 years. But they're a small portion of our portfolio, right? So if a couple of them went to zero, I don't even, it doesn't impact the performance that much.
You wouldn't even notice.
But
Anyways,
I think people need to be
listen,
careful.
Mike,
So Kevin,
sorry.
real quick. On the physical, if somebody is somewhat not risk averse, but if somebody just says, look, where's the price need to get to? Well, it's 25 today. Does it need to get to 55? Yeah, probably it does. Those vehicles are great. UPC, Yellow Cake, right? Those you can express your view that way. We think if the price goes up 2x, the real quality and the companies that have operational gearing to that can go up more if our work is right. And again, we can always be wrong. We think we're right, but that's kind of how we think about it.
Well, Mike, I hate to cut you off. I'll tell you, I'm in Kuppy's camp. I love the U. I think it's just dirt cheap. It's a limited downside, and you get kind of sitting around waiting. But listen, for people who want to learn more about you, I first of all, make sure you follow Mike on Twitter. He's a great follow. You engage people. You actually spend a lot of time. I was actually amazed. I wrote an article the other day about it, and I was shocked at how much you went back and forth people. So why don't you tell people how to follow you on Twitter and where they might, for those who are interested, where they can get more information?
Well, first off, I got to say, people need to be following you because you educate me all the time on your seriously. I mean, you are, I'm a macro uranium guy, but on the macro stuff, on the big picture stuff, I mean, you're a fantastic read. So
that's very kind of you to say. My knowledge is an inch deep and a mile wide. I don't know much about it that much.
That's great. So, but that really, I mean, but for me, I'm on Footnotes first on Twitter. I engage sometimes I don't, because what you find, Kevin, is so many people don't put the mosaic together and they come out with one random data point and they think it's important and then they keep insisting on it, and then I'm just going to mute you.
Yeah. Well, the other thing is, Mike, I was shocked. I wrote this article about uranium and you got involved, and I was just absolutely floored at how heated it became. And it seemed to me that there was a whole bunch of investors that had really kind of gotten themselves convinced that this was the next great market. And when it didn't pan out right away for them, they actually got very bitter. And I was thinking to myself, these people shouldn't be speculating in this. They are just not the right investors.
We talked about earlier in the call, Kevin, you're 100% correct. You got to learn how to scale and understand risk reward and what's your risk tolerance. Yeah, I sure, for people who've got beaten up, but you didn't have to get beat up during this downturn. So, during the equity downturn, not the physical downturn, meaning of the last, couple of years where it started to trade up. So anyway, I really appreciate the time. It was, I really enjoyed it. They were great questions. So thank you.
Well, thank you very much. So, and if you want to follow Mike, it's at Footnotes First, and your website is SachemCoPartners.com.
Exactly.
Great. Well, thanks again. Thank you very much for your time, Mike.
Kevin, I appreciate it. Thanks.
Well, Patrick, it's been great. Great show as usual. Thank you very much.
It was a good show for sure.
Yeah, no, I enjoyed it very much. You got any announcements for us?
Yeah, listen, I'm going to be at the Money Show here in Orlando on the February 6th through 8th. And a couple of our past guests, Jeffrey Hirsch, Ed Modla, and Tony Zhang are all going to be out there. And they're all going to come out for a Market Huddle meetup. And so we're going to have some beers on the Saturday, probably the Friday and the Saturday, both a double feature drink fest, because Tony probably can't make it the Saturday, so we'll have to do it. So any of our listeners that are going to be at the Money Show, make sure you stop by the Big Picture Trading booth and say hello and get the details. We're going to meet up as well. We'll include it in our regular email that we're sending out. So
basically, Patrick goes to these shows and goes out drinking afterwards and is looking for friends.
That's exactly.
Did I not sum it up properly?
Thank you. All right.
And sometimes he gets some of our guests to go with him. They feel bad for him. Okay, just a reminder that Market Huddle is available on iTunes, Android Play, Podbean, Spotify, and YouTube. Please subscribe on the YouTube channel. And not only that, if you could do us a favor and actually do a review, we'd really appreciate it. It helps us get guests. That's it. Thank you for listening. We appreciate you taking the time to join us and look forward to hopefully speaking with you or talking to you again next week. I'm Kevin Muir.
And I'm Patrick Ceresna. Have a great weekend, everyone.
Okay, hop on, Lena.
Oh, that was a nice wrap up.
You like that one, eh?
Thank you.
Okay, so I was ready to basically shit all over this beer. And
it's grown on you.
The sours are coming to you, buddy.
That's going to be a very bad thing. It basically, like when you drink it or eat enough of something, you eventually start to like it.
Yeah.
Is it more like
that's what happened to me. The first sour I ever had, I thought I was going to vomit. And now I drink sours all the time. It's going to happen to you, buddy. You're going to
It wasn't just the first sour that caused
What I love is the fact that on the can they say ballpark pairings include vanilla soft serve and Swedish berries.
Oh my God.
I can't imagine having a handful of Swedish berries and drinking this at the same time.
Actually, I kind of can.
Oh, really?
It's not that bad. It would go well with that, actually. Okay. So
is this like what baseball moms drink, when they're watching their kids play baseball?
I don't know. So Lena, what do you give it?
I have to be honest. I'm not a huge fan.
Yep.
So I would give it a 7.1.
So very middle of the road. I like it. I am gonna go, and so just for reference, most of my sours I give the bagel to. Okay, so basically any points you're doing well as a sour. I'm gonna give this a solid 5.9.
All right, not bad, Kev. Not bad. I'm impressed. I was sure you were gonna go under 5.
Well, no, that's what I'm saying. It's a sour that I actually, that's kind of my 5. Below 5, I think is you don't want to drink it.
Yeah.
Okay,
Well,
so Patrick, what do you think?
I'm gonna give this a 7.9. You know what? Yeah, I'm not gonna explain it. I'm 7.9 with no comment.
I stand by it. I don't need to explain myself. I'm like the king.
He has spoken.
I've spoken. 7.9. You know what? Thanks, Left Field, for sending us some of this. You can always send us some more free samples.
Yeah. So, Lena, what do you got planned for this weekend?
I'm going to see Jay and Silent Bob's Roadshow tomorrow.
What is that?
Yeah, I have no idea what that is.
I had a feeling you would ask. Do you know? You don't know Jay and Silent Bob?
Oh, I do know that. That's from our generation. That's old.
Like Clerks,
Yeah.
Dogma, Yeah. They're here in town tomorrow. They're doing a roadshow with their new movie.
Oh, wow. I didn't know that. That's awesome.
Yeah.
So do you
I'm
like
gonna go
Clerks?
see that
I didn't
tomorrow.
know, you like those kind of movies?
Oh, yeah.
Chasing Amy, too. That was the same vintage, right?
Oh, yeah. That was a good one. Yeah.
That's hilarious. That's awesome.
That's what we're doing this weekend.
Well, that's really exciting. Pat?
My mom was very concerned, though.
Why?
She's like, don't go anywhere public.
Oh, because of the virus. Yeah, we got them.
Yeah, and I said, well, I'm
Toronto,
Asian,
too.
so people will stay away from me. It's good.
I know.
Fine.
You know what? I've read that, but I kind of figure, who knows? I belong to this group that's on Twitter. It's like this private group with these macro kind of traders and I saw something about I get the updates from Hong Kong and all these places, these exotic places. and they'll say like everyone's wearing masks except for the and I don't know how to say the word. It's something with a G, and I looked it up, and it basically means white folk.
Oh yeah, I know the word. I'm not gonna say it.
Oh, is it bad?
No, it's not.
Oh, okay.
It's like a slang
But
term. I think it's derogatory, but I'm not sure exactly.
Okay, well, anyways, but I was kind of...
But I know what word you're talking
Okay,
about.
because I thought that was kind of funny, though, when I read that, because I was like, yeah. You know what? It's just...
It's kind of like when Mexicans call Americans gringos. Right?
Oh, okay.
So it's kind of like that.
Well, that's
but
fine. We've been oppressing people all throughout the world forever, so we can probably have some people to say some bad things about us. But I did think it was interesting because, one of my good friends, he's Asian, and he was talking about how he's going to get them and stuff. And I said, I'm not going to do that. Screw that. And he said, like, you guys, I go, yeah, it just doesn't feel right. I just can't get myself around to bringing and wearing a mask. Like, I'm going to be the last guy to wear a mask. Fuck it.
I'm just going to lock myself in the house, and then I don't have to wear a mask.
I don't know.
I don't know, 6 months of tuna is Kuppy style.
Yeah, Kuppy. Like, what the hell, man? Gonna get 6 months of tuna. Can you imagine how sick of tuna you're gonna be after that 6 months if you don't
Oh my
go out?
God.
You're gonna like.
Oh my God. I'd be sick
6
of it after 2 days. But I guess to sustain life, right?
But I don't know. I don't
Yeah,
think
that's
it's like. Lena, are you worried about it? Like, do you go and are you thinking about it?
Well, I don't know. I feel like the statistics show that it's really affecting more like seniors.
You know what?
Or
A
people
little
with
heads up for you,
pre-existing
Lena. I saw a study the other day that said it's actually affecting men much worse. So you're golden.
Oh, great.
Yeah. So you're good. I actually the only thing I worry about.
Not, like,
I don't mean to like be kind of cold, but I do worry about it. We have some family members that are little people, like 1 and 2 and 3 and 4 years old, and I do worry about those people
and babies,
tremendously. And I shouldn't joke about it. It's obviously very serious. But for me, you know what? I'll take my chances. I'll just no mask for me.
Yeah, for me, it's like life is short. I can't live in fear.
Yeah.
I gotta do what I gotta do.
Fair enough. Yeah, I could use some terrible word.
You could avoid large public places though if you're not going to wear a mask. I mean, you could be just a little more cautious about it.
Patrick sounds like a real.
But like I said, people
Patrick,
just
you're being
stay
a
away
Debbie
from
Downer.
me.
You're being a Debbie Downer, Patrick.
All right. No, I'm not wearing a mask.
You know that
I'm joining the club.
You know that
joining the club.
I'm guaranteed to get this thing now after talking trash about all
Oh,
this,
for
right?
sure. For sure you are.
It is kind of scary, but I mean, what can you do? There's no treatments right now. There's no, like, you could take all your precautions, but that's all.
All right. Well, I'm bored of this conversation.
Oh, well, then what do you want to talk about?
Let's go.
What are you doing this weekend?
Sitting
Actually,
I haven't.
I've really not made plans yet. Actually, next week I'm out in Orlando, so I'm just gonna probably chill at home with the kids. All right. Anyway.
He's gonna go. He's gonna get the virus so he can bring it to Orlando, and so that all Americans can all hate Canadians.
It's not very nice of you to say.
Well, if you brought the virus over there, they wouldn't like you very much.
Well, I don't plan on getting the virus, so. All right.
But you're the one talking about not wearing a mask.
Watch out, everybody. Patrick's coming to town.
Okay, well, we'll let you go. Anyways, Lena, have a great time at your Chasing Amy, whatever it is, thingamabob.
Yeah.
It's not Chasing Amy. Silent Bob Strikes Back or whatever, right?
Yeah, Jay and Silent Bob Strikes Back.
Isn't that not what's the guy's name? The guy that got a little heavy.
Kevin Smith?
Yeah, isn't it Kevin Smith?
Yeah, he's not heavy anymore.
Oh, really? What's his secret? Because I need a little bit of that.
I think he had like a heart attack, at some point.
So that's what I need to do is have a heart attack, and then I'll
vegan.
finally get serious about losing weight. Oh, you're right. He's thin.
I think he went vegan, and that's how he lost the weight.
Oh my God, you're right. He's thin.
Yeah, he's like fraction of the size he used to be. He's like unrecognizable almost.
Wow. But that's him, right? He's coming?
Yeah.
Oh, that'll be great.
We got VIP tickets, second row.
Oh my God, you went all out.
Excited.
That's hardcore.
You're like a real fan.
If we're gonna do it, we're gonna do
there
it
you
right,
go.
right?
You are a hardcore fan. Like you are. So tell me what is your favorite movie of his?
Well, actually, this was my gift to Luke because he's a diehard fan.
Oh, it's Luke. It's not really you. You're just kind of tagging along.
No, I like their movies, but I'm not like a diehard fan.
So what's his favorite movie?
Luke is a diehard fan. Chasing Amy. He's got a poster for it.
Oh, really? Oh, that's a good movie. I agree. It's a good one.
Yeah.
Clerks is good, but I
like how
Chasing
Patrick's
Amy
very
better.
quiet.
Yeah. Okay.
Patrick's quiet because he's never seen it.
Yeah, I know. Patrick has basically never seen any movie. He's the most kind of cultured guy when it comes to like pop culture. It's like unbelievable. And you think, oh, maybe it's because he knows so much about classic culture and he can help you with like 15th century like Renaissance
no,
stuff.
not that
whatever.
either.
Not a chance. Basically, doesn't know much about anything except Fibonacci lines. Okay, on that
You know
line.
why? Because he's always looking forward.
That's right.
That's why.
That's right. Anyways, have a great weekend, everyone.
All right.
Have a good
Cheers.
weekend.
Bye.